What is going on, everyone? This is Andrew O'Connell with Pristine Capital coming at you with yet another market recap video. It is March 4th, 2021. Please like this video and subscribe to my channel if you enjoy this content, and I will continue to make it for you. Today we're going to talk about the price action, the indices. We'll go under the hood and check out our sectors and style factors, talk about some of my trades for the day, and then we'll wrap up with some options order flow. But before we jump in, quick risk disclaimer. As always, nothing in this video should be construed as investment advice or recommendations. Please follow your own trading plan and your own risk parameters. And last but certainly not least, do not YOLO your entire account into any one of my trades. All right, let's jump right into today's session. This was, let's be honest, this was a violent trading day. There were a lot of fallen soldiers out there, stocks down 15 to 20%. And it was a bloodbath for a lot of these stocks. So we had the S&P 500 finish down 1.24%. We had the NASDAQ QQQ finish down 1.64%. We had the IWM small caps finish down 2.8%. And we had the Dow Jones finish down 1.09%. So if we take a look here, I'm going to pull up our ES futures. The market is now in a defined intermediate term downtrend, and you can see I marked these trend lines right here just to get a better feel for like, okay, what's the likely glide path in this downtrend. And you can see that today's candle, we actually dipped way below this downward trend line. We actually closed pretty much right on it. So coming into today's session, we knew, okay, we just got our close below the monthly value area. We have Jay Powell on tap for today. We were talking about this in our Pristine Capital morning webinar, and we all sort of knew that everything was going to hinge on Jerome Powell. If he had something in the way of like yield curve control or some way of just easing financial conditions and easing some of the stress in the Treasury market, that could lead to a very powerful rally. If he did not have that answer for us, that was going to lead to a pretty violent sell-off. We ended up getting the latter where we did have a big sell-off. So if we take a look here, you can see now we're clearly below this monthly value area. There's no question that this is a downtrend. Big red candle here. What was interesting is that the market is getting much more volatile. We are having these really loose and fast moves in stocks. So we're having stocks go down 15% in a day, 10% in a day, 20% in a day. And not saying that this is going to be like a coronavirus crash, but it's very similar price action in my opinion, where stocks are going no bid and the floor is just coming out and these stocks will lose 20% in a day. And that could be seen in a couple different ways. So of course, when you're in those stocks, it's never a good feeling when your stock goes down, 20% in a day, and you're like, oh my gosh, like I just got killed in that. But conversely, if you can protect your capital during these moves and make sure like, okay, I'm not betting the farm on the long side, or, you just make sure you're playing with your profits. On the back side of these crazy moves where stocks are losing 20% in a day, there are big opportunities. So that is definitely something to think about. That's something I'm going to be thinking about as well, where if you can just be a little bit patient, just make sure you're not sticking your neck out too much in this kind of market. It's very similar to if you think about the coronavirus crash last year. That happened in February, March. Think about last year. Let me just pull this up. It's just for good context. I think this is important to go over after, a tough day in the markets. This was a tough day for me as well. I scalped some Q's puts, which made things a little bit better, but still a pretty tough day. So let's take a look here. So if we zoom back, let's just remember last year. So let's take a look. Okay, and this is our 1 year chart. Hang on. Yeah, we'll go to our weekly. So this is the weekly chart here, but you can see, heading into February of last year, market was at its all-time high. This is awesome. The market dropped from 330 on the SPY, about 3,400 on the S&P 500, all the way down to, a low of 2,154. So think about that. When that happened, I certainly thought this. I know a lot of people did as well. Oh my gosh, this is going to be a terrible year for the stock market. This is going to be the worst year. Like for a lot of people, it was like, oh my gosh, I'm down so much on the year. What am I going to do? And this 2020 ended up being an amazing year in the markets. So I think the key for 2020 was, as we're going through this downward sequence, just make sure you're not going too all in. Make sure you're not revenge trading as much as possible. All of that good stuff. Of course, you can take a drawdown. That's perfectly fine. If the market goes down, you draw down, that's okay. In a perfect world, we'd all short the top and buy the bottom. That's never going to happen. But so long as you don't get carried away and you make sure, like, okay, I'm in a good spot, once those opportunities come along, then you can really seize them and you can end up having a really good year. So what we're seeing in today's market is nowhere near that level of extreme. But I just think it's important to bring up, because right now this is, we hit a high of like 39.59 in the S&P 500. Now we're down here at 37.66. And it's like, oh man, the market's 5% off of its all-time highs. Really tough market. But I would just keep that in mind, that so long as you don't, crush yourself with short-term risk, this is really just opening up more opportunities along the way. So we have S&P 500 here. Really tough day in the market. Closed on this downward trend line. At this point, though, I do think we're a little bit oversold and we could get a nice bounce tomorrow. So you'll see when I show you my trades, that's what I'm playing for in terms of just scalping. But we are in a downtrend, so we definitely have to keep that in mind. The Qs as well. I'm going to run through these really quickly. Qs, really tough day. So you can see we finished down 1.64%. At this point, pretty oversold. 3 big red candles. But let's talk about this Jerome Powell press conference today, because I think that was really like a big catalyst. For the most part, I am a technical trader, but I believe in this market, the macro is mattering a little bit more. So it definitely makes sense to just hit on it. So this is from earlier. I watched the press conference, and let's take a look. These are my thoughts, and this is why I threw on some Qs puts as Jerome Powell was speaking. But yeah, I said, in my opinion, Powell's botching this. He's not making any concessions to try to ease the fear in the bond market. Seems there needs to be a bigger dislocation to spur the Fed to act. And this was pretty important, I think. Powell said that he expects a temporary increase in inflation related to the reopening, but that it will be just that, temporary. In my opinion, this means that long-term interest rates can continue their glide path to the 2% plus mark, and the Fed has no intention of intervening before then. And I said, this tells me the correction in tech stocks is indeed justified. And I said, let's see what the market thinks into the close. I ended up adding some Qs puts, as I was just watching this press conference unfold. And sure enough, we did end up having, a pretty rough day in the markets. So if we go to our sectors and style factors, I included the Finviz Heat Map here as well. Yeah, you can see here a really tough day. These tech stocks are really just getting punished. Every day down 1%, 2%, 3%. And these are the mega cap names. The small cap names are taking an even bigger hit. One that was showing relative strength, actually, two, Google and Facebook were both positive on the day. I took a very short-term trade in Google, and I'll show you guys that in a minute. Yeah, really tough day. The only bright spot in the market was energy. And I'm pretty sure, that's the funny thing with a lot of these hedge funds out there. I just have a feeling most, are overweight tech and they're probably underweight energy, or, God forbid, they're long tech and short energy. So this move has been very, very painful for a lot of different players in the market. If we take a look at the sectors here, you can see, like I said earlier, energy positive, but all these different areas, like all of the ARK funds, very negative. You can see the ARK G down 5.76%. The TAN Solar Energy ETF down 5.67%. Let's pull up this TAN ETF. I actually want to see what that one looks like. And really what I'm seeing when I pull up a lot of these different sector ETFs is these charts just look very broken technically. And a lot of times what happens is when the chart gets this broken and there's so many buyers that are underwater, it can take time to really make that next leg up. A lot of times these things end up basing out and there's a lot of volatility along the way. So this is definitely, we have to respect this price action that's occurring here. This is definitely not something where it's like, oh, it's just a little market dip. Like there's definitely been some technical damage here. I think where the opportunity is, though, is that if you are of the long-term mindset, I think some of these sector ETFs and some of these individual names are starting to present better opportunities. Where if it's something where you're like, oh man, I wanted to be exposed to solar energy, and you were trying to chase it and you never got an entry, something like this, say if you're like a long-term investor, this isn't me trying to give anybody advice or anything like that, but you could be like, oh wow, I'm actually getting it at like a 25% discount. Like I'll pick some up maybe for my long-term account. It's a lot different if you're a short-term trader. And I do both. I do long-term investing and short-term trading. But yeah, you can see this TAN, really suffered today. A lot of individual names like Tesla. This one, I know there's a lot of big-time Tesla bulls out there. Tesla is not what it once was. So this, you can see it's in a clear downtrend now. It's trading below the monthly value area. So this one, in my opinion, if we get a nice bounce in this one, I'll likely be looking to put a short position on. Well, we'll have to see. Yeah, this one's been really good on the short side, as of late. So definitely, congrats to anyone that's been shorting this one. So yeah, a lot of these individual names imploding. Let's take a look at our style factors here. And you can see, indiscriminate selling. Pretty much what happens in the markets is, there's a lot of machines and algos that are pretty much operating the financial system. And there will be like a trigger level that gets hit, or something of that nature where all of a sudden every algo decides to do the same thing. They all decide, okay, time to hit the sell button. We're not buying here. This is too risky. And you get market dislocations like this where there's pretty much no bids. Market makers are withdrawing liquidity, and you get these huge moves. So like we had high beta stocks down, cyclicals down, momentum, just a complete bloodbath. I can see the one sector that did the best. We had the high div, low vol, only down 0.67%, and international value only down 0.37%. But yeah, and I'm just going to pull up as well just to really give more context of these Treasury yields. Let's take a quick look at these. Let's see. So I'm going to pull up my COIFIN here. Let me see if I have that up over here. Okay, might not. Let's see. I love this COIFIN. It's like a free alternative to Bloomberg. It's not quite as good as a Bloomberg. I used to use one when I worked in the institutional side, but this thing's still pretty solid. So yeah, if we look at the historical yields here, and really quick, there's been a lot of talk of the steepening yield curve. We have the 2-year, the 5-year, and the 10-year plotted against each other. When these lines are far apart, that means the yield curve is steep. When they're very close together and they're bunched up, that means we have a flat yield curve. So you can see throughout all of 2019, we pretty much had a really flat yield curve. And you can see all throughout 2020, it was even flatter. It was flat as a pancake. Now we are getting this separation between these three lines, and it's happening very quickly. So this is, almost like a parabolic move higher in rates. And that's why it's very tough for the equity market to adjust. A lot of times what happens, like I used to work on a fixed income trading desk, and the moves that are happening in the Treasury market ripple out to the equity market. And the reason why is because treasuries are used, like Treasury Yields, are used as an input to value other assets, such as equities, such as real estate. And the 10-year Treasury is very significant in the financial system. It's a key rate that's used in a bunch of different financial calculations, and really whenever you're discounting cash flows. So you can see this is a very big move in the 10-year Treasury. And today, we just got word from Powell that, hey, this move upwards in Treasury yields, we think it's normal. We're not going to do anything to intervene. And in my opinion, as much as I would have liked Powell to come out and say, hey, we're going to do yield curve control, we're going to buy the long end of the curve and push it down, I do think it sort of makes sense from their end, because if they lay out all their chips onto the table and go all in on a move to just 1.5% on the 10-year, if you look at the path of this 10-year, even in 2019, it was at 3%. If we go even further back, yields are still incredibly low. So it kind of makes sense that Powell, the Fed's not going to intervene yet. We'll have to see if we continue to have stress in the markets. At some point, they might be forced to intervene. But I could definitely see the 10-year getting back to maybe like 2%. I think that would be reasonable. If the economy's really going gangbusters, maybe it gets back up to 3%. So it kind of makes sense why some of these tech names are really coming off. And it's tough because when you're a trader and the market's just going up every day for so long, like think about it, from the March lows to where we are, where we were at the peak of the equity market, that was like an 80% move in less than a year. So everyone that's been trading the market, including myself, you're used to being in this market that it's pretty much gone up, 80% in a year. And it's like buying every dip has worked. A lot of these bad habits get instilled in everyone that's participating in the market. And, a 10% move down in the Qs, in the grand scheme, might not be the worst thing. It had to happen at some point. Like, we were seeing, like, TikTok going crazy. Like, there were so many signals, like 12-year-olds investing in the market and, like, killing it. And, like, everyone that was being prudent about risk just looking like a complete idiot. There were so many, little signs and whatever that, of course, when you're in the heat of the moment, it's like this is never going to end. But yeah, yields going up is definitely a big deal. What I will say, though, is, okay, today we got our medicine. Powell said he's not going to do anything about this increase in yields. And we did have sort of like a washout day in the markets. So if we look, you can see stocks like Tesla we already showed. All these high flyers like this Russell Growth ETF, down big. There were names like XB, for instance. I know a lot of people love this name. It's down 16% today, and I think yesterday it was down like 15%. So you have stocks that have been cut in half. Yeah, like this one was a high of 90, now it's at 46. This was one that I stopped out of today, Vuzi. I took a target at $25 a share, so this one's not really a big deal. I took a target up here, and then I stopped out of my second half in the beginning of the day, so it wasn't really that bad. I think I still ended up winning this trade. But yeah, this one down 22% today, 23%. So this is no joke. There's and this is a classic case of these assets going no bid, meaning everybody's trying to sell them at the same time. And when that happens, you get these big dislocations. So like I said, I do think there's opportunities that are starting to come up for patient investors, where if you're like, okay, some of these growth names, now they're down 50%. hey, maybe I can start nibbling at this one or nibbling at that one. But I think the key for right now is focus on preserving your capital. Make sure that you're not sticking your neck out so far that you're going to ruin yourself if the market does decide, hey, there's 10% more to go. Like the S&P 500, it's only down 5% right now. NASDAQ is down about 10. But think about it. Maybe this turns out to be a 10% down move or a 20% down move. That could be the case. We don't know. Nobody has their crystal ball. So I think it's very important to just make sure, okay, if we do get that 20% down move, or if this ends up being another coronavirus crash, I want to make sure I'm still in the game. And I want to make sure that when those opportunities come up on the backside of that, I can still take advantage of them. So I think it's really important. Like right now, it's not really the best environment to be making money. Like this is a really tough environment. But I think the key is when you get these really tough environments, there's opportunities on the other side. So just make sure you're ready for those. I just keep trying to reiterate that, but I think it's really important. So I'm starting to get excited about those opportunities on the other side. So let's take a look. We'll pull up some of my trades for today. I don't want to keep you guys too long. But let's see. If we look at... so for stock trades, in the morning, I was just taking stops. I had some trades that I put on during the shakeout, last week. I even tried, I was like, let me see if we get an oversold bounce in the ARK fund. I stopped out of this one. I just made sure, let me put a really tight stop on. So I took about $1 loss in ARK, which is okay. That's just a paper cut. DMTK stopped out for about $62.45. Skills, I took a stop in as well. Skills, another name. I think for the long term, it's going to be a great company. But this one, if you take a look, really just, this one not too bad, down 6.93%. But yeah, a lot of these names are just really, this one's in a downtrend at this point. So I just have to respect that. If this one starts regaining levels, regaining the moving averages, then of course I'll jump back in. But this one I sort of got caught because I jumped into it when it had reclaimed the 20-day, but I didn't wait for the close. So that is something for the future. Wait to make sure that it closes above that level on a closing basis. So that's definitely really important to know. So yeah, in the morning, just made sure to take my stop losses. DMTK, another one. This one I stopped out at around like $62 and change. And I'm so glad that I took my stop because this one ended up closing at $52 and change. So it went down another $10. Because that's the thing, when these algos get going, who knows, once all this selling pressure clears up, you'll see how quickly a lot of these things sort of correct themselves. But when you get these days when the market just goes no bid or these stocks go no bid, this one finished down 17%. So I'm glad I was able to get out of the way of that. So in the morning, once I took those stops, then I was able to think about things a lot more clearly. So during Powell's speech, I was like, he's really botching this. Like I said earlier, I put on some Q's puts as a hedge. I was able to make some nice money in those, and I took them off once I felt like we were at that capitulation low. So I closed those out for $15.52. I had paid $13.80 for those. So that was pretty good. That definitely helped psychologically, where it's like, okay, I have some of these other positions that are, under the fire, so to speak. But I have at least a hedge on that's doing pretty well. I also have a TLT hedge on as well. That one did, pretty good today as well. And then what I did was, once I saw things were getting pretty oversold, I was like, okay, I just raised this cash. I took some stops and I made sure to have a bigger cash balance coming into today. I was like, let me try to add some things opportunistically. So HAAC is a SPAC. It's a healthcare SPAC. And this one is very popular. I know there's like a bunch of healthcare analysts that really like this one. And this one, if you take a look, everyone's saying like, oh, the SPAC bubble is imploding. But I do think there's opportunities for people. You can get into some of these really good SPACs. This one was at a high of $15.20, which that really didn't make much sense, to be honest, it being that high before it even announced an acquisition. But I was able to pick this one up for about like $10.76, really close to that $10 par value. So I feel comfortable with this, where it's like if it goes down to 10, no big deal. But who knows, if they announce a nice acquisition in healthcare, maybe this thing goes to 12, maybe it goes to 15, you never really know. Maybe it goes to 20. There's a lot of SPACs that have done that. So I was like, okay, this is where I'm going to plant my flag in this sell-off. So I took some exposure there. And then once I closed my Q's puts, I put on some trades that I really just want to use for cash flow. I was like, let me see if I can play this oversold bounce. So I got long some Google and I got long some Pinterest. So if we take a look here, Google is just showing incredible relative strength. And you can see Google actually finished positive on the day, and it's holding this monthly value area. So this one just looked pretty attractive. I entered some Google. I'm about flat on that trade right now. And then I entered some Pinterest as well. This is another really popular name, really strong company, and this is definitely one that it typically is one of the first for dip buyers to come in and really support the stock. So this one, I believe I picked up like $68.60, like up a couple pennies on it, nothing crazy. But if we get a bounce day tomorrow, what I'm looking to do is probably monetize this Google and Pinterest. If we get a really nice bounce, I'll probably look to put some hedges back on. And if we don't get that bounce, I just want to make sure, okay, I have nice tight stops on these trades I put on for cash flow. If the market doesn't go my way and it doesn't bounce, I'll take paper cut losses in them and just make sure that I'm there to fight for another day. And then from there, just waiting and watching and just sort of letting the dust settle. So yeah, this is definitely one of those environments where it's not like that sexy environment where stocks are doubling like it was before or anything like that. This is definitely one of those environments where, just focus on the risk first. Don't really think about, trying to double your money in a down market or anything like that. And this is going to pass. So with that being said, hope you guys all have a great night, and I will see you all tomorrow.